Hello everyone, my name is Ted Gibson. I want to thank you for taking the time to be here today. We'd like to talk to you about how risk management impacts your insurance program and costs. Today's speakers will be Paul Neeson, Tom Skelly, David Haynes, and myself. Our intent is to educate you and provide documents with take-home value that you can utilize in your business today. Also, throughout the presentation, if you do have a question, please feel free to type it in on the GoToMeeting area and we'll answer the question as soon as we see them. If we do not catch it in time, don't worry about interrupting us, just tell us to stop. There will also be a link on the last slide that will have all of the questions and answers, the presentation, and also the take-home worksheets. I want to give a quick thanks to Jean for helping organize everyone to be here, and I will pass it over to Tom Skelly.
Thanks, Ted. The insurance industry has a problem. We do a very good job of presenting products and talking about insurance coverages with clients. However, as we'll show you later during this presentation, insurance is only 1/5 of the risk management process. The key to controlling costs is to control risk before the loss. Proactive, preventative, pre-loss training and planning leads to control of risk. Companies that control risk ask themselves, what are the largest risks to my profit, my customers, my vendors, my employees, and how can I manage those risks? An example of this is the survey Lloyd's of London performs every 2 years. Last year, a survey of 500 C-level executives, that's CEOs, CEOs, and COOs, showed that the top 5 concerns were reputation, compliance, governmental compliance, HIPAA regulations, OSHA, cyber attacks, both internally and external, commodity shortages, succession planning, and the lack of quality employees. Nothing to do with insurance coverages or policies there. As a matter of fact, you would have to scroll down to number 48 out of 50 on the list to read about insurance coverage. This is a red flag for my industry. The message is clear that agents and brokers should be having conversations around risk and proactive preventative planning and training. This type of planning and training will help an organization do 2 things: lower their total cost of risk and make them more attractive to the insurance underwriters. Total cost of risk is a concept used by risk managers from larger organizations, but can be applied to any size organization. It has 2 components: direct costs, deductibles, premiums, gaps in coverage. All of these items are paid in cash. Indirect costs, reputation, employee morale, time. Time, for instance, to train a new employee for someone who may be out of work due to a workers' compensation loss. Time to devote to lawsuits from employment practices liability. Total cost of risk allows an organization to look past premiums and see the true cost of an unplanned loss. No one likes to pay insurance premiums. The way to control your costs is by managing your risk effectively via a plan. I'd like to introduce Paul Neeson to you today, and he'll lead us in a discussion on how to manage risk.
There are several ways that you can manage risk, perhaps in no order of importance, but starting off with mitigate or reduce the risk. For example, the risk of a fire can be reduced by installing automatic sprinklers or fire extinguishers. If the business is a restaurant, loss can be mitigated by installing an extinguishing system in hoods and ducts. Another way is to avoid the risk. An example that most of you are familiar with would be to refuse to place light industrials because of the higher risk of a workers' comp injury. Third method is to transfer the risk. For example, you own a building and are concerned about liability claims. Some of the risk can be transferred to the tenants by insisting that the tenants buy liability insurance and that you, the building owner, be listed as an additional insured. A fourth way is to assume the risk. For example, most property insurance policies offer deductibles of $500, $1,000, $2,500, and higher. Another example would be a large company buying a self-insurance policy for workers' compensation. And the final method is to finance the risk, simply buy insurance. In other words, transfer the risk of loss to an insurance company. Please note that 4 of the 5 ways to manage risk that we mentioned are non-insurance. The non-insurance methods should be considered first.
Paul mentioned the 5 ways to manage risk, and the next step in the process is to identify your risk. Who within your organization is defining your risk? The definition of risk is different for each stakeholder. Different stakeholder, different definition. The CFO's view is different than the sales staff. The placement administrator's view is different than the owner's view. And I can repeat that the only way to identify your exposures is by asking yourself a series of risk assessment questions. And on this slide, you will see the sample risk assessment questions that we use with our clients. And as I said earlier, this will be available to you on the link that we will show you on the last slide. The first exposure we've identified is disaster recovery. How would your company respond if your office space and all contents were destroyed? Could you rebound? Here are a few scenarios we have run into with clients. The first is flood. There was a bank in Newton, Mass, the town over from us. They kept their IT department in the basement. They had a flood, and everything in the basement was ruined. They worked with an outside disaster recovery vendor, and they were back in business by that afternoon. They had a trailer, generator, and a satellite uplink, which gave them electricity and connectivity needed to run their business. And they were able to get back up the same day because they had a plan. The next example is fire, and this one hits home to Delaney Gibson. We had a fire in our building 7 years ago. Our plan was to find open office space within the area, and luckily when this fire hit, the space happened to be across the street. Our workstations and operations were back within 24 hours. And the only way we were able to do this is because we had a plan.
About 10 years ago, we were brokers for a staffing company based in California. Someone broke into the office and stole the server. The server contained all of their resumes, accounts receivable, and customer listings. We anticipated a large loss because the cost of reproducing the accounts receivable, the customer listings, would have been very high. Fortunately, this company had a plan that mitigated or reduced the loss. The server had been backed up the day prior to the theft. The only loss was the computer itself.
And the outside disaster recovery vendor that I mentioned earlier on the flood example is Agility Recovery, and that will also be available to you for more information on the last slide.